Hello, welcome to AntKast by Ant Group. It's a podcast that brings you deep into conversations with global thinkers, innovators, and entrepreneurs on groundbreaking technology and how they're shaping our lives for better or for worse. I'm your host, R.T. Warfield, coming to you from London. For this episode, we're going to discuss a new topic for the podcast, and that is how should people new to investing deploy their capital? According to Bank of America, younger generations in the U.S. are saving more than ever. Nearly 3 in 4 millennials are actively saving. Younger generations are also investing at an earlier age. According to a study by the CFA Institute, 31% of millennials with taxable investment accounts started plowing money into them before age 21. During the pandemic, we saw a surge in the number of individual stock market investors. According to Bloomberg, individual stock market investors in 2020 made up an estimated nearly 1/5 of U.S. equity trading volume, a 4% increase from the year before and a doubling from 2010. For more on the topic of investing, we have 2, let's say, super experts from Vanguard, one of the world's top investment groups. They will give some professional advice on how to start investing and plan a path to building greater wealth. Globally, Vanguard has more than $8 trillion invested on behalf of its 30 million clients. Maria Bruno is head of U.S. wealth planning research at Vanguard, and Joel Dickson is Vanguard's global head of advice methodology. Both are in Malvern, Pennsylvania in the U.S. Welcome to the show.
Thanks, RT.
Thank you. Good to be here. Thanks.
Great to have you. Thank you so much for joining us. Now, before we start, full disclosure, I have investments through Vanguard, so I just want everyone to be clear about that I use Vanguard for my investment.
Great. How are you feeling about that right now, RT? That'll give me a sense of where we're headed here.
Well, I was going to say, for full disclosure, Joel and I are as well.
Yeah, that's true.
Well, I would just say it's one of my investment vehicles that I use. So I just want to keep it at that.
Gotcha.
So anyway, that's my endorsement. So we're here to talk about investing, and to kick things off, I'd like to start with why invest at all? What is the point of investing?
I'll just start by saying more and more over time, the last 30, 40 years in the U.S., and we're starting to see this more and more globally, is that people are kind of getting more and more responsible for their own long-term retirement needs or cash flow needs, spending needs, and so forth. So it's not just that your working years fund your lifestyle while you're working. You also need to be able to think about funding a lifestyle or an approach for when you're not working. Mm-hmm. And that may mean longer term, that may mean during periods of unemployment, but it's not as simple as maybe it had been in the past of, hey, when you stop working, things are taken care of. It might be a pension payout, it might be government transfer, or money for meeting your basic living needs. While some of that still exists, more and more the onus has gone back to the individual to be responsible for funding their own long-term needs. Mm-hmm. And that's the reason for investing.
Joel, I think I would just add to that. I think there's a difference between saving and investing. So when I think about investing, I'm saving, I'm investing, putting money aside for something that may be a mid or a longer term goal, like a house or a retirement, right? Those are typically the bigger ones. That's different than saving. I might be saving for, later this year I need to do this or that, or I have to have an emergency savings account or something like that. So there's a little bit of a difference. And I think it's important because it's how you select the investments to go into a savings account versus an investment account can be different.
Mm-hmm. Yeah, I think that's a really interesting point you bring up, Maria, because I know people who I talk to about their saving, and they say, well, why do you invest so much, in the stock market? Why do you do that? Your capital is at risk. But I just save money, in T-bills or in the bank, it's going to be safe and I can save. So why, if your capital is at risk, why would you want to invest your money rather than just save it?
And that's a good question, because when you define risk, there's different types of risk. And what you're talking about right now, RT, is market risk.
Mm-hmm.
Right. So with investing, there is some type of risk, and there's no guarantees with investing. Mm-hmm. You direct monies into an investment account, and then you're exposed to market risk. And that depends upon what you're invested in, whether it's the stock market or the bond market or a cash liquid reserve. So these types of investments are invested differently, and the risk associated with that can be different as well. So when you're investing for a long-term goal, maybe retirement, for instance,
right,
that may be 20, 30, 40 years away, the thing you need to think about is inflation. So when you have a longer-term goal, investing in, and we'll talk more about this, in a globally diversified stock fund or a balanced fund gives you exposure to investments that are designed to grow or keep pace with, or grow more than inflation. So you need to think about risk in terms of market risk, okay, and that's the risk that I am dealing with when I select investments versus an opportunity cost of not investing, right? Mm-hmm. If you think you're playing it safe by not investing in the stock market, for instance, for a longer term goal, then that investment is not growing, does not have the potential to grow on an inflation adjusted basis. So when you go to actually spend those dollars 20, 30 years down the road, they're worth a lot less because of the impact of inflation over time. So it's important to think about different types of risks when you think about investing.
Do you think that a lot of investors? Oh, go ahead. I'm sorry. Go ahead, please.
No, RT, I was just going to say, and kind of from Maria's point, it's safe doesn't mean the same thing for people.
Right.
So you haven't quote unquote lost any money by keeping it in the T-bills or some at this point non-interest bearing bank account, but you have lost quite a bit of money to inflation, as pointed out, and even over the short term that's been the case. So how you think about balancing these risks that Maria had laid out and what that means for you being able to achieve your goals, you kind of need to think about what safe means here, because there's really not a lot of certainty when you start looking over long periods of time along many dimensions.
Mm-hmm. But the flip side of that, Joel, though, is this safe, right? So if it is something where I know I need to buy a new car in 6 months, or I have, the heater's gone on the house and I need to buy a new heater. That's something that is a known cost in the near term, and you do want to play it safe. So that's where liquid reserves, those types of investments come into play, because you don't have the time horizon to deal with the volatility of the stock market on a day-to-day basis. So,
absolutely, yeah.
Right.
That's where if we get back to the saving versus investing thing, that's where there's too much. There's the risk of market exposure there for short-term needs is not really going to be worth it. That's where the success in those cases is about the amount that you're able to save in order to meet those short-term needs. And that's why a lot of times I think people are like, oh, well, my investment return was X. Yeah, okay, but even if you're saving for 3 or 4 years, if you have a goal even 3 or 4 years from now, the vast majority of your ability to meet the goal is how much you save for that goal, not the amount of the investment return over that time horizon. The time horizon, if you're talking now 20, 30 years, then the investment return may matter quite a bit more in terms of your ability to meet the goals that you have, combined with the amount that you're saving. But over short periods of time, relatively short periods of time, honestly, the investment returns just don't matter that much. And it's all about how much you're able to put away to meet that goal.
I see. I see. So, putting money away for investing, when should somebody start doing that? At what point in their life?
Yesterday. No, kidding aside, right? You always, there's never really like ideal time to invest. You just want to do it, right? And this is where people may feel like, okay, well, I don't have enough. I'm going to wait until I have enough to invest. And it's like, no, a better mindset would be to start investing in what you can, right? Even a little bit, because of the power of compounding. The money that you invest in today has the potential to earn over longer term. So the earnings are reinvested, and then those earnings earn more return as well. So there's no ideal time, but you really want to first make sure what you're investing for, and then invest accordingly, and then just start saving. And I would say if you can set it up automatically, where you can do an automatic exchange from a bank account, for instance, or some type of direct deposit, it takes the decision making away from us as individuals, and it creates this excellent discipline for periodic and regular investing.
And I'm going to add here another thing too, especially so for younger investors, the concept of investing may also mean different things. So there's what we're talking about right now is kind of financial investments. But also as folks are younger, maybe just entering the workforce and so forth, there's also an important investment that many people look at. You think about human capital investment. You think about your own education or increasing your human capital earnings power. It may be talked about in different ways. But there are certainly some good return on investments for paying for education, for example, in the U.S. that may have a good payoff for the outlay that's going to be there. So that's another way of saying there might be good opportunities to take on some, and you might take on some debt to actually invest. And I'm not saying take on debt just to consume it, but that there may be opportunities, especially early for younger investors, that investing in yourself can also provide a huge amount of dividends, while hopefully you can also invest a little bit in the, from a financial standpoint, just to start it and gain on the compounding that Maria mentioned.
Right. So, looking at the ROI on anything you put your capital into, whether it's education or training or stocks or starting a small business, right? Yeah. So can I just ask you, for the listeners, so maybe not all of our listeners are familiar of the term power of compounding. Can you explain what that means?
The concept of compounding is, as you make investments and you invest dividends from those investments, right? Different types of investments may pay dividends, maybe annually or quarterly or monthly. By the power of compounding, you reinvest those dividends into more shares. So what happens is, over time, let's just say maybe you bought 100 shares of XYZ investment, and then you reinvest those dividends. Over time, those 100 shares then continue to literally compound. So the dividends buy more shares. Those shares then have a greater earning potential, and then those dividends buy more shares. So over time, your 100 shares could grow, exponentially, depending upon how long that time horizon might be. So that's the power of compounding, in that the earnings actually grow and then compound into greater earnings. It's almost like a snowball effect, right? As the snowball rolls down the hill, it gets bigger and bigger and bigger. It's the same thing with investing. If you reinvest your dividends over time, that pot then continues to grow.
I'm gonna there's this popular kind of rule of thumb called the rule of 72, and basically it's your money doubles over periods, basically compounding on the rule of 72. So, for example, if you were to invest for 9 years at an 8% return, 9 times 8 is 72, you would expect that your money would double over the 9-year period. I like, and that's the kind of power of compounding, because if you can keep compounding at that rate, you're doubling every now 9 years. So if you started, 9 years later, you have half the amount of money of somebody that started 9 years earlier than you. And so that type of piece of it's kind of like this, sometimes this puzzle that comes into play, or people will sometimes do these math games of, hey, would you like $1,000 or would you like a penny on the first day of the month that doubles every day for the 1 month investment horizon? And you start thinking about the multiplication, the compounding that occurs, because a penny a day that doubles over the course of the month of January, you end up with, if I did my math right, about $10.7 million at the end of January, starting with a penny at the beginning of the month. And that's just because
that
of
really
that
shows
power
the power
of compounding and being able to build on previous amounts of investment as you keep the money at work longer.
Right. So Joel, that 9-year doubling, roughly, that example you gave, that means without putting any extra capital in, that's just on its own.
That's right.
Right, building on its own. Okay, got it. So Maria, I asked earlier, said, when's the best time to invest? And she said yesterday. So obviously it's better maybe to start investing when you're younger. I know I have a relation of mine that was always saying to me, I didn't take investing seriously till I was in my 40s, and I had to save half my paycheck to catch up, basically, is what he said to me. So is there a lesson in there? Does that something that, the earlier you start, the better it would be?
Yeah, and that goes back to this power of compounding. So if you can, the earlier you can start, the less than over that period you actually have to invest because of the benefits of compounding. And that's why, as Joel had mentioned, most young investors are competing with investing, but also either paying down debt or their living expenses. So we can sit here and say, oh yes, start saving yesterday, but the reality of it is many, particularly young investors, feel that they don't have the means to do that. And the message there is to start small. So, you may not think that small amount will make a difference over time, but it is pretty astounding if invested how the potential of that account can grow. So it's really a question of resource allocation and to start early, because then over time you actually have to invest less.
And I'd add to that there are also many times incentives that are available to investors that do start early that can build on those, whether it might be a retirement plan offered by their employer that may match contributions, whether it might be tax incentives. For example, in the U.S., there's a savers credit that is available, or even something like that just isn't used very much. The savers credit isn't claimed as much as it could be. And even for somewhat lower income working individuals in the U.S., there's an earned income tax credit that is available that often is not taken advantage of. So there are incentives and ways to build that nest egg, even when it's small amounts at the beginning, over time. So yeah, you just need to understand there is some money in the system to help.
That's very interesting. Good advice. We were just discussing, how do you have to prioritize, your savings, because you've got young people have competing, things like debt and student loans and other things, and they don't make as much as older people. So do you have any advice besides, I know Maria mentioned earlier, allocating a certain amount in your paycheck every month to go to your investment? Beyond that, do you have any other suggestions or ways of goal setting or planning, something like that?
Folks face a lot of goals. They have a lot of different ways they're going to spend their money, living their lives, just generally the outlay, of being, of just working generally and living life. But then it may be, hey, I need to have a bit of a rainy day fund. I need to be thinking about, I may want to buy a house, or may get married, may have children, may think about, the expenses there. Then it's like helping them. And then, retirement is so far off for many people that, it's one of those, though, to the point that we've been talking about, if we can put a little bit of this on automatic pilot, it will help make things easier down the road. I will say there are, along this line, there's just a lot of things here, and I do think there's simple approaches that better. And Maria mentioned one earlier, which is, hey, look, is there a way to save kind of off the top? One of the things that we see with people generally is that spending tends to be whatever the available resources are. So, for example, what hits the bank account tends to help define how people spend. So if you can sort of trick yourself in many ways to have less available to spend, you might behaviorally, there's been some evidence that can be helpful. And one way of doing that is, as Maria had mentioned, is you think about saving off the top. If you can save even a small percent of your income that may be then matched or some other way, to increase that amount, it means that less than from your, let's say, your paycheck is going into your bank account, and now you may be able to get into the habit of having that regular savings and still living the life or having the standard of living that is acceptable for you from what is remaining from that after savings amount. So, these defaults or these automatic plans that can get you to save first can be, from a behavioral standpoint, very beneficial in establishing that over time and that repeated behavior.
Yeah, and I would just add to that too, Joel. I mean, this, setting it up automatically, as I'd mentioned earlier, and then also the ability to increase that amount every year, either by inflation or a set amount. For instance, here in the United States, for those of us that have access to employer-sponsored plans, as Joel had mentioned, many employers offer what's called the company match. So they may match the investment dollar for dollar or a certain type of percentage. And that's free money. And that should be the first source of investing for many of us, to take advantage of that quote-unquote free money. But also the ability to set up these accounts so that there is an automatic increase every year. It could be a 1% increase. So for instance, we often say that, a goal for saving for retirement for someone who is young and just starting out, or frankly, actually through earning years, is to save about 12 to 15% of your income for retirement. Well, if I'm having that conversation with someone in their early 20s, I mean, their eyes are going to roll back to their head and I'll lose all credibility. But my message there is, first start with what you can. Let's just say you can do 5%, and let's say your employer matches 3%. That's 8% right there. And if you go on an automatic increase every year of 1%, by 30, you're there, right? So you're there in a very disciplined way, as opposed to feeling this burden of this big number all at once that, quite frankly, for many investors, it's not achievable at an early age. So start with something where it stretches you as an investor, and then set it up automatically with ideally an automatic increase. And then over a period of time, the discipline is set and that good savings behavior, that good investing behavior is there.
And
So that's the key, I think, to a lot of this, is to try to take the emotions out of investing and try to make it as automatic as possible through automatic exchange programs.
So I'm also going to add to that, paying down debt is saving. So, because you're reducing a negative saving, if you will. So, a lot of times where we see, especially younger investors that may be more, constrained in terms of their income or their availability for credit or so forth, where we see folks get into a spiral of problems is if you have revolving credit card debt, that you're paying, say, 25% interest on. You see the emergence in the U.S., payday loans and overdraft fees from checking accounts and so forth. These things may not seem like large dollar amounts individually, but they, when they add up, they really draw away from the ability to save longer term. And so, not having a recurring credit card balance, for example, that is generating 20% interest, paying that down is like having a return of 20%. So you need to think about, and especially in good times. I mean, you may, again, in the tougher times, if you're going through something, that may be a relatively low cost source of funds. But it's still one that in normal times, is very expensive and actually hinders your ability to save longer term. So, understanding those dynamics, that paying off debt, and especially high interest rate debt or avoiding high interest rate debt, is a very strong form of savings.
Before we go, last thing, I just want you to imagine I'm 25 years old, fresh out of graduate school. I got $100,000 in debt. Just got landed my first job. They have 7% matching. What kind of advice are you going to give to me? What should I be doing?
Okay, I'll start. So kudos, you landed this job. It's got an excellent employer-sponsored matching. Take advantage of that. And then what I would say is think about your debt and day-to-day living expenses holistically. So college debt, maybe your inclination may be to want to pay that down immediately. I would think about the context of other debt you might have or living expenses and prioritize it accordingly, because there may be tax benefits, particularly in the U.S., that would make that student loan debt not as much of a priority as potentially as other goals. Joel, you can add to that.
I'm not going to add a lot. I'm going to say, if it's dollar for dollar, 7% matching, and if you're in the U.S., because there are ways to tap that, even during your working years, if absolutely needed in an emergency, that's your first source of investing. Take advantage of it up to the full amount if you absolutely can. So 7% gets you 14% total in the instance that you provided, and then just don't incur additional debt. That is high interest rate. So don't have a credit card balance month to month, and then. Then you've got the rest to spend and figure out, as Maria was saying, hey, how do you think about balancing? You're going to have some debt payoff that you have to do, but you also have a bunch of things that you're going to be thinking about in that new job. Boy, am I going to go back to school at some point? Am I going to get a house that I'm going to want to own, and I need a down payment for? Am I going to have kids maybe a little bit later in life, and do I need to think about how I'm setting myself up from that standpoint? So I still think there's a little bit of a goal discovery piece, RT, that you kind of need to be doing and thinking about what are the things that as I look out, I want to at least start planning for a bit and thinking about, and the rest of it is available for you to spend or to think about what your goals are. So I don't think there are any really great rules of thumb after that point, because, at the end of the day, you're going to be fairly successful in meeting your goals if you're saving 14% off the top and don't have a lot or any high interest rate revolving credit card debt.
Yeah, Joel, the only other thing I would add is, and this doesn't really sound exciting, but particularly if you're just starting out, I would take a couple months and do a budget and take a look at where that money goes, because you might have, depending upon the situation, you might have excess funds, and actually looking back and seeing where this money went for a few months is not a bad idea, because you can get a sense of, are you saving enough, or are you balancing these goals enough?
That's a really good idea, and it's something we should have talked about earlier in many ways. When you think about like these no-cost or low-cost apps and so forth, there are actually budgeting and spending apps, or even your bank account, your checking account, and your credit card. You kind of you can get an annual transactions, and be able to categorize them fairly easily in a number of online or app-based programs to kind of just understand where the money's going, how much you're spending every month, and then you can make decisions around that about are there ways to free up maybe more savings and investment capacity, or are you comfortable in what you're doing from that standpoint. So that's a really good thing starting out, is just, even if you're not doing a detailed line by line budget, just understanding broadly where the budget and spending that you're doing really is, and the big rocks that make a difference there.
Excellent advice. Brilliant discussion. I learned so much. This is so educational. We'd like to thank Maria Bruno, the head of U.S. Wealth Planning Research at Vanguard, and Joel Dickson, who is Vanguard's global head of advice methodology. Thank you both so much for your time.
Well, thank you, RT. It's been a pleasure.
Thanks, RT. Good to be here.
Thank you for listening to this episode of AntKast. Our conversation with Maria and Joel continues in our next episode, where we will discuss different ways of investing, the importance of diversifying your portfolio, as well as hearing their thoughts on some of the younger generation's patterns of investment. That's it for this episode of AntKast. To make sure not to miss a single episode, please subscribe on Apple Podcasts or Spotify. I'm RT Warfield, coming to you from London. Thank you for listening. Bye for now.